I want you to go to DeFi Llama right now and analyze this $105 billion industry right here. You'll notice from the top platforms like Lido, Aave, Eigenlayer, EtherFi, Athena, all these platforms, they are not meme coin platforms. They are not NFT platforms. They are not short-lived trends. They are high-quality platforms doing one thing, and that is producing real yield for the investors using these platforms. And it's as simple as that. And this is exactly where cryptocurrency and DeFi whales are parking their assets right now. In these platforms that have $25 billion, $20 billion, $11 billion, $5 billion, $2 billion, so on and so forth. The point is they are not targeting short-lived trends. And the reason why is because they do understand that these are short-lived trends and they don't want to back short-lived trends with their capital and end up being exit liquidity. They would rather leave that for retail investors. So my question to you is if you want to be a standard retail investor and end up being exit liquidity this market, or if you want to be a retail investor that takes advantage of opportunities with the market and uses those opportunities to take profits along the way so you have something to show for this bull run. These platforms are not generating small amounts of money. Over the past 7 days, Lido has done $22 million in fees. Aave has done $12 million in fees. Athena has done $13 million in fees. Maker has done $10 million in fees. Uniswap has done $30 million in fees. Jito has done $33 million in fees. And the list goes on and on and on. These are racking up millions and millions of dollars every single 7 days. And there is cumulatively over $100 million in fees being generated across DeFi every single week at this point in time. The question is if you want to actually take advantage of those hundreds of millions of dollars in fees happening every single week, or if you want to leave that advantage to whale investors. Because the beauty of decentralized finance is that anybody in this industry, including you, including me, including a random person that we've never even heard of that has maybe a dollar to their name, can take advantage of this industry because it is permissionless and it is decentralized. And guys, these fees are not speculation. These fees are not token emissions. These fees are not token inflations trying to pay out rewards or anything like that, like most platforms do. This is real yield. This is saying, hey, if I go over to Uniswap right now and I execute a trade where I trade, let's just say, some Ethereum for some Aether token, I am going to pay a very, very small fee. And as a trader, that fee is going to be substantially less than if I were to trade on a centralized exchange. I am going to pay roughly 0.3% on this trade right here on a decentralized exchange, whereas I would pay 3% on this exact trade on a centralized exchange. So as a trader, I have a huge advantage. But also at the same exact time, this fee is going to go to the people enabling this trade and making this trade possible. Ultimately, those are liquidity providers for Ethereum and for Aether token that decided to take the other end of the trade and buy up our Ethereum and sell us the Aether. So as a retail investor, well, we have two advantages here and we can be on both sides, right? As a trader, we can obviously pay much, much lower fees. But then what most people don't end up doing and what we could end up doing is liquidity provision, where we can actually earn these fees. And these fees do stack up. And it kind of just puts in perspective how much money these centralized exchanges are actually making. And the reason why I say that is because we can get APRs of 100 to 150% per year on pools like Ethereum to Aether, stuff that is revenue driven, stuff that has solid fundamentals, 100% per year. Just imagine how much the centralized exchanges are making when they are charging 10x the fees that are being charged on Uniswap or being charged on other decentralized exchanges. And guys, crypto and DeFi whales are not chasing the next big thing. They're not chasing, high emissions. They're not chasing high APRs. They are chasing the assets. They are chasing assets that have solid fundamentals, stuff that is almost guaranteed to grow. And of course, they're chasing pools that are consistent and sustainable. A lot of people probably wonder why over on Uniswap, there's just this consistent $3.5 billion in TVL. And if you break this down, there's still $1.5 billion on Uniswap V2. The $1.5 billion on Uniswap V2, that is full range liquidity. That is liquidity that's probably earning 5 to 10% per year. Ultimately, it's real yield. And it's with full range liquidity pools that don't really have to be managed. That's exactly where institutions have parked their money over the past, 1, 2, 3, even 4 years, and they have left it there. They have left it to be sustainable. With Uniswap V3, you could see that is growing in market share and now has $1.9 billion in TVL, and ultimately some of that is going to start to get shifted into Uniswap V4, which has roughly $60 million in TVL. But the thing is, these whales are slowly shifting their money over to these different variations because they want sustainable and they want consistent returns. They would rather take 50% APR consistently without having to manage their pool every single day and without having to take a ton of risk every single day managing their pool, than ultimately get 100% APR or 150% APR. Because the truth is, 50% is a damn good APR. And a lot of us actually end up forgetting that. We want to chase the highest yield, we want to chase the next big thing, but we ultimately miss out at the opportunity that's right in front of us, right? And this is something that I often like to look at on my own portfolio. What is your time adjusted return? Let's talk about the real yield model and how that works. We have a liquidity pool, which is ultimately a smart contract, which if you don't know what a smart contract is, I think now is probably a good time to subscribe and let me know down below in the comment section that you want a video breaking this down, so that way you guys can stay up to date. But a liquidity pool, and then in order to get money into that liquidity pool so traders can execute trades, obviously money doesn't just spawn out of thin air, right? We have liquidity providers. These are the people that are earning money. These could be whales. These could be people with $10, right? Anybody can be a liquidity provider. But these liquidity providers, they put two assets in the liquidity pool because the liquidity pool is two assets. So we'll just say XXX, YYY. That's what a liquidity pool is. This could be Ethereum and USDC. This could be Ethereum and Aether. This could be wrapped Bitcoin and Ethereum. This could be CBBTC and wrap Bitcoin, right? Point is, the liquidity provider puts both assets up. So let's just say this right here is asset XXX, right? And then over here we have asset YYY, basically. They're putting both assets in the liquidity pool at the very start. And the reason why they do that is because they want to earn trading fees, right? They want to earn as many fees as possible. So they're going to go and choose their concentrated liquidity range. They're going to go and put assets that they truly believe in, but ultimately they're still going to look for solid pools with good fundamentals and stuff that they actually believe in, right? And then over here, we have the traders. These are guys that are executing trades and making the liquidity providers money. And this is not a bad thing whatsoever. And ultimately, this is a win-win situation. And the reason why it's a win-win situation is because the liquidity providers are now able to earn fees and earn on opportunities they previously wouldn't be able to earn on. Traders are now able to pay 90% less fees. They could pay roughly 0.3% on a trade, whereas they go and they pay 3% on a centralized exchange. So they are happy to pay this to liquidity providers, by the way, because they're paying a lot less than if they're to trade on a centralized exchange. Anyways, with that being said, this trader comes over here and they want to execute a trade. They might put token XXX in and take token YYY out, right? Simple as that. That's how simple the model is. They put one in, they take one out. And as this liquidity provider, their position is going to be rebalanced. And what that means is if they started with, let's just say 10 XXX and let's just say 10 YYY, maybe now that gets adjusted to now having 11 XXX and say 9 YYY, right? And the reason why is because they just gave away one of their YYYs and they took in one more XXX, basically. That's the simple version of it, right? Obviously, that's not to the T on the math or anything like that because there is adjustments within the numbers. There's a whole algorithm behind that. That liquidity pool does all the math, right? It's all automatic, and the smart contract does everything. With that being said, I want to break down how this actually works and where those fees come from. This trader might put in $1,000 of XXX, but ultimately they might take out, say, $999, right? So that extra dollar, that's what goes over to liquidity providers, split amongst the people that are providing liquidity in this pool. You might say, hey, $1, that doesn't sound like a lot of money. You're talking about high returns. What if I want to deploy $1,000? What if I want to deploy 10,000, 100,000, a million, so on and so forth? Well, my point is, when there is $98 billion in volume over the past month on Uniswap alone, there's $3.5 billion of liquidity. That's a lot of fees being generated. And that's a lot of fees to split amongst even the $3.5 billion that's on Uniswap. Not to mention, if we were to drill down into this, the past month, the majority of this volume of the $98 billion was in Uniswap V3. $87 billion was in Uniswap V3, a huge market share in volume, right? Whereas over here, if we look at this, Uniswap V3 makes up for $1.93 billion of the total $3.5 billion in TVL. So people that are providing liquidity on Uniswap V3 right now are earning substantial fees, strictly because there is a lack of liquidity compared to the overall volume. But this model right here is real yield. The trader pays a fee. That fee goes directly to the liquidity provider. It's not putting new tokens in circulation. It's essentially the trader accepting the fact and saying, hey, I'm going to pay a fee because I'm executing a trade. And trades have fees associated with them. Simple as that. Now, where you get a little bit tricky is where you have other models, and in my opinion, a little bit fishy models, right? Where all of a sudden this liquidity provider is no longer earning the fees. This liquidity provider is actually earning incentives from a third-party source, right? And perhaps they're earning ZZZ token, right? And they're just getting ZZZ token for providing liquidity. And this ZZZ token, how are they being paid out ZZZ tokens? They have something called the mint, where they put new ZZZ tokens in circulation to be able to pay out the liquidity providers. So they put new tokens in circulation, inflate the supply of the ZZZ token, which ultimately causes the price to go down, and then they give those ZZZ tokens to the liquidity provider. And these fees over here will go to people that are like staking the ZZZ token. It's not as efficient of a model. It's not as consistent of a model. It's not as sustainable of a model as something that's simple as this. At the end of the day, less is more in DeFi. That's exactly why platforms like Uniswap are generating $30 million in fees in the past 7 days. It's a very, very simple model. People want to trade. They pay money to trade. Liquidity providers earn that money. That's $30 million into the hands of liquidity providers. And a lot of those, yes, are institutions. But again, it could be retail investors like you, like me. We can take advantage of these opportunities. Now, that being said, over the past 4 years, I've formulated a strategic framework for building out portfolios like this. I currently have $18,000 in this smaller portfolio of mine. It is generating a 200% APR. I am doing $100 per day. Will I continue to do 200% APR? Absolutely not. But because there is immense trading volume in here, I'm able to get 200% APR instead of the normal maybe 10% per month that I would get, right? And ultimately, while I might still be at a $220 loss on this overall portfolio, which is, keep in mind, 1.1%, I am profiting compared to if I were to just stick money in underlying assets and hold in the market like most of you are probably doing, right? So I have more money than somebody that were to just go hold Desync, Ethereum, and Ondo token. And ultimately, the people that are holding Desync, Ethereum, and Ondo token, they're down about $700, nearly $800, whereas I'm only down $200. So you need to look at it from that perspective. And if you guys are ready for me to reveal my strategic framework, I'm going to be doing so in my next video. So make sure to drop a like, subscribe, and notifications turned on. I'm going to show you everything next video. And I hope you guys enjoy it. I hope you guys find value in it. And I hope you guys found value in today's video. Again, if you guys are interested in this industry, I am trying to keep you guys updated with everything that's going on it. So I would appreciate if you subscribe and notifications turned on, but also so you don't miss out on my next video where I reveal my strategic framework. I'll see you guys in the next one, and peace out.